Thank you for joining me today. My name is John O'Hare. My friends call me JJ. I'm going to get right into understanding market-linked investments. So why understanding market-linked investments? Well, because they're complicated and they're different than stocks, they're different than bonds. And if there's one product that I get the most number of questions about, especially years after using them, it's probably market-linked investments. Market-linked investments, as a short history, are a relatively new financial product. And by relatively new, I mean they were developed in the 90s. But as I joke with many people, mutual funds were actually developed in the 20s, and most people didn't start widely using them until the 50s. Hedge funds were developed in the 50s. People didn't really start using them until the 90s. And private equity in its modern form was really developed in the 80s, and I'm not even sure everybody still knows what that is. So the fact that structured notes are developed in the 90s means it's still some time before they're much more widely popular and better understood. But let's get into what they are. So very, very simply, they've got a few things in common. They're designed with really one of the three key objectives. They either are trying to preserve your capital. I don't want to lose money. We want to grow, but we want to do it in a risk-managed way. Or the last one is we want to enhance our income. And that's something that we talk about regularly. Now, there's 5 things that are in common with these things. The best way I always think to understand these things are examples, but for the purpose of this, I'm going to go through sort of the major terms you need to understand. And then at the end, I'm going to go through the examples, which I think is honestly the best part of the presentation. There are 2 types of structured investments or market-linked investments. Those terms are often used interchangeably. One is called a market-linked CD, and one is called a market-linked note. 90+% of the time, we're talking about market-linked notes. So market-linked CDs are FDIC insured, they're guaranteed, and they are full protection. So remember before I talked about capital preservation, this would be one where I have FDIC insurance up to the normal and applicable limits. That has ultimate capital preservation. We don't always talk about those as much. We're usually talking about market-linked notes. So they are secured by the credit risk of an underlying issuer. What issuers do you use? Typically large multinational banks. So think JP Morgan, UBS, Deutsche Bank, HSBC, BNP Paribas, Bank of America, Morgan Stanley, Goldman Sachs. I mean, you can kind of go down the list. If you can name a large multinational institution, financial firm, they're probably on the list of people we can do these with. Next thing they all have in common is an underlier. So they're all tied to something. Remember, they're called market linked. What market are they linked to? The answer is they can be linked to multiple different markets. Market indices. The S&P 500 is a market indice. The Russell 2000, the Dow Jones. Those are all market indices that they can be linked to. An ETF, they can be linked to sectors like a tech sector or an energy sector. In equity, they can be tied to a specific stock. Commodities, gold, oil, they can be tied to those indices, and currencies. The euro, the won. Realistically, market-linked investments can be tied to any financial indice that you can track. So they all have a maturity. So fundamentally, these things are bonds. You are lending money to one of these companies for a set period of time. Those vary. Some can be as short as 6 months. I've seen one out to 15 years. Typically, we see them between really a year. Many of them are 2 to 3 years. And then really kind of the long end maximum tends to be closer to 5 or 6 years. Some of them are callable, meaning they can be called early, and some of them are not. So it's careful to read which one is which. Protection features. So going back to that capital preservation piece, some of them offer different types of protections. First type is a market-linked CD. That's fully FDIC insured and protected. That's the FDIC insurance I talked about earlier. But some of them have what we call buffers. And buffers work exactly like this graph describes. And although this chart doesn't have any numbers, theoretically, if a buffer was, say, 20% of the index, we'll call the index, for sample purposes, the S&P 500. If the S&P 500 drops less than 20%, so 19.9%, and you have a hard buffer at the end of the note, right, the due date, the observation date at the end, if we're only down 19.9%, we get 100% of our money back, right? The first 20% is on the issuer. With a hard buffer, additionally, if the market's down, say, 25%, it's down beyond that buffer. Well, then in this case, the market is down 5%. Again, that first 20% is on the issuer. So that's how a buffer works. There's also another version called a barrier. A barrier works a little bit different. Barriers typically have deeper numbers. So although it's not perfect, oftentimes if a buffer was going to be 20%, a barrier would be something like 30%. But in this case, if the market goes down less than 30%, we'll use that as the example this time. Just like in that graph, that green, we don't lose anything. We get all of our money back. But with a barrier note, the key difference is at the end of that period, at that observation date, a couple years later, if we are still down beyond 30%, we get the return of whatever the index was. So if the index is down 35, that note is down 35 as well. Right? Whereas if it was down just 29.9, we get 100% back. So there's a level there that very quickly clicks over. And then, of course, the last, some of them offer no protections. So they have enhanced upside or enhanced income protections, but no major downside features. A couple of different ways they can pay us. Market participation. So not to be very confusing, but one of the things they do is what we call a multiplier. So if you see that number there, it says 0.75, 1%, and 1.8%. What this means is that 1% is matching the index. So if the index is up over that period, let's say 20%, if you're 1 times, you're also up 20%. But if you're up 1.8, you get 1.8 times the return, right? So you add another. So now, in fact, instead of being up 20%, the market would have returned 36%, or the market link note would have returned 36%. That's the enhanced upside. So that's a participation rate. You can also have slower participation rates. So if the participation rate was, in this case, 0.75, and you're only up by 20%, well, this note only returns 15%. So it returns less than the market. But hopefully, if we do these things right, if we have lower participation rates, we should be getting more protections. And if we have higher participation rates, oftentimes we expect less protections. Fixed payments, so sometimes they're sort of like bonds. There's a 9% fixed payment as long as the market has done XYZ or stayed above a barrier, and it's a set period where we're going to get a fixed payment at the end. And lastly, some of them have periodic coupons. Now feeling very much like periodic coupon bonds, that you get set income over different periods, usually semi-annually. That's very, very common. So recapping just briefly, there are 5 things that every market-linked investment needs to define, whether it's a note or a CD, the underlying indexes, the maturity, what kind of protection features it offers, and what kind of payout features it offers. We actually work with Raymond James and iCapital, as well as Luma through Stewart Partners, and we have access to dozens and dozens and dozens and dozens of notes every single month. What happens is the issuer comes up with an idea. There's a development of that idea. So if they believe that the S&P will go up over the next few years, they come up with a pricing structure using options and available current interest rates, and they create an offering. Those offerings come out every month and they close every month. Each new market-linked investment is typically its own initial public offering. And although, like today, the examples I'm going to use, there are many like them available, but usually not for the exact terms. The terms change month to month depending on the market conditions. So they're not exactly the same, but they're often very similar. Big things to consider, creditworthiness. You're going to lend money to a company for a set period of time. You got to be very sure that you're going to get it back at the end of that term. Liquidity. These things are typically not very liquid. They do have a liquid market for them, but oftentimes we're not in the business of selling them early. As a result, they also don't price particularly well. So an illiquid investment, if somebody's going to take it off your hands, usually wants to buy it at a discount. So the offers we get for these before the full maturity date, because as I should have stated before, all of the terms only apply on the maturity date if you hold it until the final date. Anytime before that, you're selling it on the open market at fair market value. You want to understand the performance of each index. Make sure that you understand the index. Some indexes are very easy to understand, like the S&P 500. Sometimes the indexes are more complicated to understand. There are fees for the initial putting together of the note, and then the taxes. The tax treatment is different offering to offering, but the good news is most of these end up being in the capital gains treatment. So even if we're trying to get income, because they're usually a year long, many of them are treated as capital gains. So there's a tax advantage to these as well. Risks to consider. It's funny, these are all the things that I just listed, just repeat it again. And before I get to examples, I want to run through a few definitions. So this for me is always the fun part. What holds the sword? So follow along. These are kind of the examples that we might be hearing or you might be talking about, or as we might be looking at new notes, what kinds of investments we might be making. So the very first one I'm going to look at is a market participation principal protected note. What a mouthful. Key points here, the underlier is the S&P 500. I think that's an underlier most people are familiar with. The term is 5 years. This one is 100% issuer protected notes, meaning that they promise to pay us back 100% of the money we invest, no matter what happens to the market if it goes down. But that's backed by the issuer. And the participation rate in this case is 1.2 times. And it has a market cap return of 35%. So it caps the overall return. And why would it cap the overall return? Well, it's promising not to let us lose money over that time period. So there is a cap to the upside. From here, there's only really 3 things that are going to happen. One, the market's going to do great and we're going to be up. 40% of the S&P 500, this note will cap out at 35%. Additionally, maybe the market doesn't go up nearly as quickly, but it goes up moderately, it goes up 20%. Remember, we get this market participation rate of 1.2 times, so the note will actually return 24%. It'll have grown faster than the market. And the last scenario is the market is down over that time period on that observation date. That's for that final 5 years. So if the market's down 22%, we get 100% return of our original principal. So good news here is on the downside, we vastly outperform. On the upside, we'd outperform. And on the very much upside, we do underperform, but we still get to participate in a lot of the market upside. This is why we don't talk about market-linked CDs as often. This is how they work. Because of the FDIC insurance, usually the terms just aren't as favorable for us. So this note is exactly why we're not talking about them as quickly or as nearly as often. This is almost an identical note. We've got a 5-year term. We've got the S&P 500. We've got 100% FDIC insured backing of the note. And now our participation rate is 1 times, and our market cap return is only 30%. So it's a little lower. So our terms on the upside are not as favorable, but we do get FDIC insurance. And again, there's only 3 things that happen. The market goes way up, we cap out. The market goes up and we match the market. The market goes down and we get a full return of our principal. So again, great observation. If you're very worried about where the market's going to go for the next few years, this would be a great note to buy because you don't have the risk of losing money. You're FDIC insured over that period of time. But you are giving up some of the upside and you're not getting, and the question is if you think that a issuer would be around, maybe it would have been better to take the increased participation rate and the higher cap for a similar type guarantee from the issuer instead of from the FDIC. Buffered notes. So we're going to use the S&P 500 again as another underlier. Again, these can be multiple different ones, and we're going to get into some other ones, but for now, let's stick with the easy ones. Term 4 years, market protection 20% hard buffer. This one has a participation rate of 1.2% and a market cap return of 50. So here, there's a few more things that can happen. But what does this look like? The market goes way up, goes up 60% of that time period. What happens? We cap out at 50. The market goes up a lot. The market goes up 30%. We're up 36. 30% times 1.2 is 36%. That's our return. We'll be able to track that to the day from the date of the original observation to the date of the last observation, which is published on the prospectus. Scenario 3, the market goes down 15%. Remember, we've got a 20% buffer, so we get all of our money back. We get a full return of our principal. In the last case scenario, the market's gotten crushed over this period of time. The market's down 27%. We, in this case, are only down 7%. So in the worst case scenario, we outperform. In the not great scenario, we outperform. In the upside scenario, we outperform. And in the way upside scenario, we do cap out. But this whole idea really, in many cases, is about hitting, singles and doubles instead of trying to always hit a home run. It's about consistently doing a great job over a long period of time. Barrier notes. So this is to contrast buffers and barriers. Remember, we talked about this before. This one we're going to tie to the S&P 500, or excuse me. Finally, have a different index. We're going to tie this one to the Dow Jones Industrial Index. 3 years, protection is going to be 25% contingent barrier, so our barrier is a little bit lower. And this one has a participation rate of 1.5 times and a market cap return of 40. So we've got a shorter period, we've got slightly better participation rate, we've got a slightly lower cap, and we've got a slightly deeper barrier. What happens from here? Scenario 1, the market shoots up 48%. We cap out at 40, right, as per the cap. Scenario 2, the market goes up 20%. We get 1.5 times, so 20 times 1.5, 30% returns. Scenario 3, the market goes down 12% over that 3-year period. We get full return on principal. So acts very much like the buffer in that regard. Here's the difference between a barrier. The barrier is deeper at 25%, but if the market goes down 31%, we will get a return of 31% of our principal. So there is a big switch there on that buffer versus barrier, and that's why typically barriers are also lower. So they're less guarantees on the very extreme downside, but they're usually deeper in general. So there is a trade-off for those things, and it's one of those things we take into consideration when we're balancing out these portfolios. Digital and market participation barrier notes. Boy, these names are a handful, but really the understanding of how they work is more important. We're going back to the S&P 500. This one's a 6-year note, and we have a contingent barrier of 30%. So what is a digital coupon payment? Well, the digital coupon payment is 40%. Let's talk about how that's going to work. Scenario 1, the underlier goes up 62%. We get a 62% return. We match the market on the extreme upside. There is no ultimate cap. The 45% return, right? I think I might have said 40 before. The underlier, if it's only up 25, we get a digital note. We instantly jump up to 45% at the end of this period. That's the return if the market is up even 1%, even 0.1%. If the market is the same or up at the end of this period, we jump up 45% return. Right? It's only on an extreme upside we then match the market again. On the downside, remember we have a barrier in place. So the barrier is 30%. We're down 15. We're within the barrier. Our principal is returned to us. And on the extreme downside, the market's down 38%. We get a 38% loss. So in this case, in the very extreme downside, we match the market. On a downside and a moderate downside, we outperform the market. On a moderate upside, we outperform the market, and on a extreme upside, we match the market. So again, it's about taking a calculated risk as to what we think might happen with these indices. So let's talk about autocallable step-up barrier notes. So one of the things I mentioned before was about enhanced income. Really, all the notes I've talked to up to this point have really kind of been focused around growing, right? Ultimately, growth. This one's about how do we get better income? How do we generate sort of extra returns without just buying bonds? Because, well, for most of my career, bonds were not fantastic. And more recently, they become much more positive. But what if rates go down again and maybe we don't get as much yield? Well, there's got to be other places to look. This is one of those places. So this note is really tied to the S&P 500 and the Russell 2000. This is a lesser of, and the reason we do a lesser of is because we'll get better returns, but it means that both indices need to meet the metrics. This one goes for 4 years and has a protection of 30% barrier feature, and it has a 9% per year call feature. Right. So, not to make this too complicated, what really happens is if on the first year both indices are up, right? Because we need the lesser of, so both of them need to be up. They're both up. We're going to get called. We're going to make 9%. And if one of them's down, it continues for another year until the next observation date. And then we make 18. And if for some reason they're still down, well, then we go to the third year and we make 27. So it goes all the way up to 36. Every year we add 9% to try to make up for the year that we missed previously. Why would we do this? Well, it's a more consistent way to do it. And most of the time, with market fluctuations, you can take a couple of years of this happening. So these are, remember, less liquid investments. Part of the reason we do these is because we're trying to make consistently 9% per year. If you look here, this is the different scenarios. Exactly that. Very often these things get called in the first 2 years, and we make the 9% per year return. Scenario 2, the market is down the entire time. It's never up on the observation date. And by the way, it only needs to be up on the observation date. The rest of the calendar year does not matter. It's just the observation date. But it's down each and every single time. If that happens, well, at the end, if it's still not down past the barrier of 30%, we get our initial return, our initial principal back. And if, under the worst case scenario, it not only never hit any of those, right, earlier on and got called away and the note ended then, so it missed all 4, and the indexes are down 35%, we're down 35%, we're matching the market. So why do we do these? Well, we know that historically that's unlikely, that scenario 3. It's always possible, but there's very few periods in which you could time the market just right in order to make that happen. You'd have to be buying at the absolute peaks right before major economic disasters and huge market pullbacks. And even in some of those, you don't even hit these things. But in that case, we take the risk of the underliers. And the previous ones, we're probably going to get the 9% return, and we know historically that we get these returns something like 90+% of the time, right? And there's very few exceptions where we don't get these things called away in the first 2 years. A different type, but again, similar, talking about income. How do we get income? Again, tied to the S&P 500 and the Russell 2000. This one has a 3-year time period and a protection of 30%. This one is paying us 6.2% annual rate, but it's paid semi-annually. And as long as both of those indices are above their barrier level, we get paid the coupon. So as long as the S&P 500 and the Russell 2000 are not down 30% on the anniversary date, we get our coupon, just as we'd expect, right? We get paid 6.2%. Now, if it's below, in that case, then we miss that payment. So we miss, but only on that observation date. And if it rises back above it at a later date, that's where those check, XX check comes in. There's those 2 X's are one of those indices being below it for that period. We miss those coupons, and then we start getting again as it rises back above that barrier. And then at the end, that last scenario, that's, again, the market was down, stayed down in that final observation date. The market's down greater than 30%, and we are subject to the barrier again. That is not the only few types of structured notes. There are a whole bunch more. And part of the reason we like to use these things is because this is what hedge funds were made and designed to do, was to do this strategy, was to make money when markets were relatively flat, or return 9% when the market went sideways for a year. This is what they're supposed to do. The difference now is we think they're much more transparent. We can do them in as little as $10,000 pieces for people. And for us, structured notes are a completely different strategy than traditionally stocks and bonds. And so they offer a different type of risk managed investment. We also ladder these things out, as pointed out in this slide. We don't want them all to come due in one day. So we buy them in those $10,000 pieces, and we can ladder them out over several years, several months, different issuers, and really create sort of an in-house hedge fund for our individual clients while being very tax efficient. So for us, biggest considerations are that illiquidity risk. You want to make sure you can hold through to the end. We have 2 things that are always out there, what we call the intrinsic and the market value. The market value is what somebody will pay you for today. The intrinsic value is what would it be worth if it came due today. And if you can imagine this for a moment, if you have a market multiplier of 1.5 times and the market's up 10, you'd expect to receive 15. Well, the market might only be offering up 12. And if it came due today, it'd be worth 15. But if the note still has a year to go, we have to wait that year to realize that intrinsic value, right? For that intrinsic value to become the market value. Up until then, it is the market value. So we do have a liquidity risk with these. We want to make sure that we're not over-invested in them. We want to make sure people have liquidity when needed. But for us, these are one of the great new innovations in the financial industry that I think ultimately actually benefits the individual consumer far more than the larger players. So with that, I want to conclude our presentation. I hope everybody learned something. And if you have further questions, feel free to reach out to me or my office. We're happy to answer them. Thanks, everybody. I really appreciate it.